Hello and welcome to the latest market update for the month of August with Andrew Dawkins and
myself, Daniel Bajwoluk. How was August for yourself, Andrew?
Well, I think all in all, I think my calculator said we had 2 dry days
Yes.
in the month of August.
It's double my calculator then. We're getting sunshine now, hopefully. Fingers crossed. Now the summer's over.
Yeah.
So how do the markets fare? Do they fare better than the weather, or is it just the same?
Well, August traditionally is a very quiet time. There's a lot of people go off for the summer breaks all over the world, not just here in the UK, and that was the case this time. So trading volumes were thin across most sectors, which means that the volatility generally increases as trades are placed, and if there ain't that much action, then a few trades can actually have a big impact. So all in all, unfortunately, August generally for most of the investment funds that we recommend was another poor month. So I think we're getting very used to this. We had a good month in July, and then we go, okay, well, this is one step forward, and then we take another step backwards. And once again, we caught with people just wanting to see an end to inflation. And inflation in the Eurozone actually ticked upwards against expectations, which causes then the ECB, the European Central Bank, another bit of a challenge because they're relentlessly putting up interest rates as Bank of England, the Federal Reserve, and all the other major banks around the world. So we look set for a period of more guesswork as to when inflation will come under control and when the central banks will stop the stupid policy of rate rises.
As we always do every month, travel around the world, and I guess we can start with the mighty US of A. How do they fare?
Yeah, so the beginning of the month saw Fitch, a credit rating agency, downgrade America from AAA to AA, which really is inconsequential, but it caused traders a bit of alarm, and so we actually saw that the market was quite volatile at the beginning of the month, but again on light numbers. So credit rating agencies, I suppose, have some use, but way back in 2008, the great financial crisis, they were the ones that were tipping these great debt schemes as AAA and safe as houses, and they were actually a lot of rubbish. So I don't think really anybody should give these credit rating agencies much respect in terms of past performance, but it sort of started the economy off in a bad way in America for the start of August. Things then sort of improved. Employment numbers are continuing to be very strong, and apparently there's 1.5 jobs available for every worker that's looking for work. So it's again that crazy thing where what the industry experts are wanting to see is unemployment increase, so people losing their jobs, which is a horrible position to be in, but then it will cheer the market up. So it's a perverse world. It really is. Consumer spending rose in a very good July, but the economy grew but slightly less than was expected and got revised downwards. But still, the US by huge margins, the world's powerhouse, and so we want to remain fully invested there. Again, we've seen the top 7 companies have accounted for around about 80% of growth within the markets this year, which is a phenomenal figure for 7 huge companies to do that. So yeah, a sort of up and down month for America, but all in all, sort of fairly uneventful, I think we would say.
And now we'll travel across the pond to UK and Europe. How did they fare last month?
Yeah, so the UK saw inflation tick downwards, as many people had expected, simply because of the fact that the tariffs for the crazy amount we pay for energy were reduced, meaning that the bills become more manageable, but still hugely expensive. So that brought inflation down, which is good news. Unemployment ticked up slightly, but they still reckon that there's a million excess jobs available for people looking for work in the UK, so the labour market remains quite good. Economy continues to grow, so July was a bit of a funny month, but June was very, very good. Basically, because the weather was quite decent in June. It was a long time ago.
That's right, yeah.
Over in Europe land, the rest of Europe land, then unemployment continues to be an issue. For example, in Spain, you've got unemployment figure there is 10.8% of the working population, but for the under 25s, it's at 31%. So it's a huge youth unemployment issue, and that's mirrored across many countries in Europe. On the more good news side, then, well, UBS, the mighty Swiss bank that took over Credit Suisse at a knockdown price, well, they declared a quarterly profit of $29 billion US, $29 billion US, which makes it the most profitable trading period for any bank in history. So it probably shows what a bargain they got from Credit Suisse. I think we could play the piggy bank and have some of the action, but we got in a bit too late on that one. So, so US, in Europe rather, the inflation rate ticked up, unfortunately, across the Eurozone. Many experts were predicting that was going to come down because of the fact that fuel's a lot cheaper than it was, etc. But the underlying challenge is because you've got central banks putting interest rates, it's increasing inflation. It's as simple as that. Because you've got to pay more for things. If you're a company, you borrow a lot of money, then you pass those cost increases on to your consumer. So it actually doesn't work too well, as we've said many times before. Italian economy did quite well, growing ahead of that of the French and German economy. Germany's still in a bit of the doldrums because they rely a lot on exporting things, whereas here in the UK we better at services rather than making things. So saw some challenges ahead for Germany and a shrinking working population as well. Not issues for them. But it's still been the best performing sector out of all our sectors, Europe, for this year, and funny enough, for the last 5 and 10 years, overtaking the US. So very, very good to see on that. So longer term, then that's where we'll make money.
I guess finally we can travel over to the Far East and how they performed last night.
Yeah, so Japan came off the boiler a wee bit. They had a fabulous first 6 or 7 months of the year. So the economy started to sort of show the signs of perhaps profits being taken. So that came down. The rest of the sort of emerging markets around the world, a bit of a mixed bunch, really. Some good figures out on consumer spending, consumer confidence. China's still a bit of a laggard. A bit of economic news that came out, which some of it's good, some of it's not so good. So a bit of a mixed bag. But still the big challenges with the property market and the amount of lending there is involved in property, which is causing huge challenges behind the scenes for some of these regions in China and the Chinese government. They started doing a little bit of trying to stimulate the economy, but really sort of half-hearted measures because there isn't much really they can be doing unless they're going to do a fundamental change in the way that the Chinese system works. So it sort of dragged the emerging market sector down. We don't have much exposure to China. We tend to deal with companies that export to China, but actually Chinese companies within the portfolio and within many of the emerging market funds we recommend, we try and keep that exposure low in any event.
How about our good old friend fixed interest and that performed in August?
Yeah, so fixed interest, which is, as we know by now, lending money to companies or governments, then the lending money bit to the government is still the biggest loss-making asset within the fixed interest sector on the long-term investment, the longer end, because of the fact that people are still thinking that the bank base rate will probably increase again and therefore hold off, so it makes then the assets you already hold then less attractive if interest rates are going to go up. On the corporate side, lending money to companies both in the UK and worldwide, then that was, it was the only area of growth for many of the funds this month. Still got a way to go because of the big fall that saw last year, but perhaps we're starting to see a bit of a resurgence of fixed interest as long as inflation doesn't come back in a big way, and that's still the worry. So it's an asset class we keep a close eye on, but it's again an asset class that we think has perhaps got one or two nasty treats in store for us. So therefore we want to limit exposure still on that side of things. But longer term, with the investments, that's where we make money and that's where we score. It has been a dreadful 2022. So far, 2023 has been fairly flat, and we won't see things get better. It will get better, and I think probably we'll start to see a big difference once we get into spring of next year, providing we have a fairly mild winter and there's no more upset from our friends in Russia and Ukraine. But there's lots of things that can happen, but short term we can't do much about it. We just double down. We keep faith with the investment funds that we've recommended for years and decades, and it will come good. It always does. It always will. And remain fully invested so that when the markets do pick up, then we're in for the big profits that will eventually arrive.
As we do every month, we'll look at the A.R.D. Consultancy portfolios and their performance over the last month, 1 year, 5 years, and 10 years. And firstly, we'll start with the defensive portfolio.
Yeah, over this month it's down 0.44%. Over the year it's positive 0.14%. Over 5 years up 8.9%, and 10 years up 56%.
Moving to the cautious portfolio.
This month down 0.75%, over the year up 0.59%, over 5 years 16.4%, and over 10 years 82%.
And the balanced portfolio?
This month down 1.22%, over the year down 0.12%, 5 years up 21.6%, and 10 years up 112%.
And the capital growth portfolio?
This month down 1.53%, over the year flatline at 0, 5 years up 25.5%, 10 years up 134%.
And finally, the aggressive portfolio.
This month down 1.76%, over the year up 0.48%, 5 years 30.9% growth, and over 10 years 159%.